The call of the question is, what is her initial basis in the property? A taxpayer purchases rental property for 160. She uses 25,000 cash and obtains a mortgage for 135. She also pays the closing costs of $10, which would include 5,000 in points on the mortgage and 5,000 for bank fees and title cost. What is her initial basis in the property? Can you tell me what is the initial basis in the property? These set of questions are exactly the way we do it in GAAP, which is accounting. These are easy. So what is the purchase price? What is the purchase price of the asset? See, the asset was at, nope, Naveen. The asset was bought at 160. How you paid 160? You paid 160, 25 you paid in hand, and the next 135 you got a EMI arranged. But the property price was 160. There was a closing cost that you had paid, but for this closing cost, points on the mortgage means it's interest. So many a times you will see in your EA papers, point means interest. Points paid means prepaid interest paid. Interest is never capitalized. It is treated as a revenue expenditure. And bank fees and title cost, bank fees plus title cost is going to be capitalized, which is $5,000. The total amount at which you're going to bring that property in your books is $165,000. Remember, interest, premiums are all revenue. They are not capital expenditures. Is this clear? Can we move ahead? Okay. Now, this is the next thing that I was talking about. Let's take one or two more questions on this, then we will go to that exception criteria. You're supposed to compute the basis in the property of a taxpayer. There's a taxpayer who purchased a home for $200,000. He incurred the following additional expenses. So I know that $200,000 is the purchase price. I would add certain direct related costs to bring the property to its present location and condition and fit for its intended use. 200 fire insurance premium. No. Mortgage insurance premium. No. Recording fees. Yes. Ownership title. Yes. So the total amount becomes 2. Okay. Next question. What is Mr. Peter's basis in the property? Can you guys give me the answer for this? I'll wait for a couple of minutes till you solve this. Mr. Peter purchased a small office building during the year. Included in his costs were the following. There's a down payment, and he took a loan of 300. He paid title insurance, fire insurance, attorney fees, and he also paid rent to former owner to allow Mr. Peter to occupy the office building prior to closing. How many of these or how much of these costs can be capitalized? Can you give me the answer? Give me 4 and then write the answer for me. 4 and then write the answer. Don't rush. Take it a little slowly. Others, I'm waiting for your answer. Okay, cash payment, I know. Mortgage, I know. Title insurance, I will include. Fire insurance, I will not include. Attorney fees, I'll include. Now, understand what we are saying. Rent to former owner to allow Mr. Peter to occupy the office building prior to closing. What do you mean by saying prior to closing? Let's say in the month of April, I'm supposed to sign the agreement. Okay, so let's say, and I'm giving you a very strange reason, but in India, it is one of very important reasons. Okay, so let's say I want to buy a property for living and I consult my astrologer. This guy says next 2 months, you should not buy anything new. So next deal, everything is clear, but you will execute the sale deed only after 2 months. Have you guys heard of this in India? Yes, no? Have you heard of this? We say it's a big thing to go and invest in a property because there's a vibe of that property, this and that. Okay, so what do? You say, okay, I finalize that property, but I'm going to execute the final things and everything which is closing. I will do it after 2 months. But I want to go and start staying in that property now. Okay, because I don't want to do the paperwork, but I'm ready to move into that property. So this guy says, okay, for 2 months, you pay me the rent. And after 2 months, when you finalize that property, I will sell it to you. And I agree. For those 2 months, is that rent considered to be a part of the ownership? The answer is no. It's a pure rental agreement. After 2 months, when I'm going to close the deal and when there will be a final sale that is effected, after that, that amount will not be applicable. So the total amount that will be capitalized will be 353,000, not 357,000. Whoever answered 350, now that's a very vague answer. Who answered 350? Follow me, can you unmute yourself? Why did you answer 350? How could the answer be 350? The closing cost has to be added, no? How can you forget this 2,000? How can you forget this 2000? Even attorney fees. How can you forget this? Sakshi, unmute her. Follow me. Tell me. I cannot hear you now. Why this 2 and 1000 was ignored by you? And Sakshi, what about you? Why did you answer D?
It has written title insurance.
I
The
told you
title.
title insurance is the only one. What about the attorney fees? Why did you not consider that? There was no answer matching this. That is why. When you get a question like this, always know you're doing something wrong. I told you only the title insurance will be considered, no other insurance. Right? So the answer becomes C, which is $353,000. Next question. What is Sarah's basis in the house and land which was purchased from Sam? Sarah purchased a house on an acre of land from Sam on 30th of June, year 3. Prior to the purchase, Isra had been renting the house from Sam for 500 per month. Following amounts were paid. There was 100,000 in loan proceeds to Sam, 2,000 in points to the bank, 1,000 in real estate taxes that Sam owned to the town, 1,000 in past due rent to Sam. There's a closing cost and there's an amount which is escrowed for real estate taxes to the bank. Can you tell me how much of this would be included? Okay, out of these, what are the figures that you're 100% sure of? See, this is important because I've paid this, right? I'm 100% sure of the amount that I have paid. The mode of payment could be different things, but I have paid this. To the bank is actually interest. I'm going to ignore. Closing costs to the bank for legal recording title, this has to be there. I know this 1000, so I know this 100 has to be there. I know this 1000 has to be there for sure. What I'm very sure it cannot be included is escrowed amount, I know will not be there. Past due rent will not be there. Even the interest will not be there, right? Because the interest cost I'm not going to add. It's a normal regular costs. Only remember guys, construction period interest is added. If I am constructing, so let's say if ITC is constructing its own, okay, let's say if I am paying and I'm constructing my own house, then during the construction period, only the interest will be added, not after construction. Okay, so if you're buying a ready-made house, then the interest cost is revenue, not expense. So this is also not there. So what is there? This is also not there. This is also not there. Yeah, this is important. If I am paying some money that the owner had to pay, then that means, and if this money is not going to be reimbursed to me by the owner, that means this is the additional consideration that I paid, right? This is the additional consideration that was paid by me. So even this 1000 have to be added, and the purchase price of the building in my books becomes 100 and $2,000. This is clear to everybody. Look at this question now. What is the amount and character of their expenses? Mr. and Mrs. Weed own a house that they rent to non-related parties. They had some major expenses during the year as follows. So this is basically a question that is again talking about what is revenue, what is capex. But this is additional improvements. So I'm doing some additional improvements on the property. I want to know how much of it is capex, how much of it is revenue. So I paid 2000 to replace the cabinets in the kitchen. So imagine I am having a house which I've put on rent, and every time the old tenants were there for 5 years. Now I have to prepare the house before the new tenants move in. So what I do, I replace all the kitchen cabinets, I replace the stove, I replace the dishwasher that is built in, and I also resurface the tub. Resurface the tub means I have a bathtub, but I don't want to replace it. So what I'm doing, I'm asking the guys to come. They would resurface. That means they will remodel the old tub. They will clean it and then they will coat it with new stuff and then they will make it usable. So what of these expenses are capitalized? How much of these would be expensed? See, this is the only one which is regarded as a revenue expense. Anything else is actually restoring the property. Can you see? Anything else is restoring the property. You are replacing it for the new thing, which increases the value. So all of these would be capitalized. So this becomes 3100 would be capitalized and 400 would be revenue repairs. So the answer becomes D. Is that clear to everybody? Because then we have just one more concept before we move on to the next topic, which is gifted property basis. This is this concept. Now see, I'll first make you understand why do we have this provision and then we will go through this provision. What is the basis of land in Coleman's books after the purchase? So I'm talking about one particular asset that is after the purchase. Coleman purchased Bernard Shaw Enterprise for $450,000. So I paid total 450 and I bought a full company. All of the liabilities were paid off at the time of purchase. So what is the asset that I got when I acquired the new enterprise? I got something which was worth in the market at 550, but I paid a lower price of 450. How am I going to split this 450 into 550? That is the question. Is this clear? I have paid less. I had a bargain purchase because what I got in my books was worth more than what I paid for. So I got a bargain purchase in my favor. Okay. Call of the question is how much would be the value of land that I'm going to put in my books? Okay. Okay. This is good. I don't know, Sakshi, if you've done this before or not. But see, general rule, what people do is they just take all of these fair market values and just split it on the basis of fair market values. But the answer is wrong. You're not supposed to do that. Law is very clear. See, what does the tax law say? What I'm going to do is I'm going to allow you. So when there is a lump sum purchase, the one that we just saw right now, I bought a full property which had land and cash and debtors and everything. What am I going to do? I'm going to take the fair market. So general rule is if my fair market value is higher than if my purchase consideration is higher than the fair market value of the goods that I get. So what I'm trying to say is if I have paid a price which is higher, so purchase PC is your purchase consideration. But if what I have paid is more than what I have acquired in terms of fair market value, then I'll simply take the fair market value of all and I'll split the amount on the basis of the relative fair market value of these assets on the day of purchase, which is very clear, which is very good. The problem happens when I have a bargain purchase. If I have paid less, then now there's a problem. Why? Because now I cannot ignore that certain assets are more liquid than the other. I cannot deal with the liquid assets in the same way in which I'm going to deal with the non-liquid assets. So what they're saying is, if that happens, and if there is a basket purchase that we just did, right? I got so many things which are liquid and illiquid items, and I paid a lower figure than the worth of what I was receiving. Then they say that first look at the fair market value of the properties and then rank them in order of the liquidities. And you will not split everything on the basis of relative fair market values. What we have done is we have stratified the entire thing. First, consume all of cash because I know cash will not reduce in value. Then go to marketable securities, debtors, other mark-to-market, for example, investments. Then go to inventory, then go to PPE, then go to intangibles, and in the end go to good. And in this, when you're going, if there is anywhere that you're stopping, that becomes the end point. Okay, now look at this question. We'll solve this question to understand how the provision has to apply. So what I'm doing, I'm giving you total of 450,000 in the bargain purchase. What I'll do, I'll first remove 50,000 totally. How much is left? The balance becomes $400,000. So I have money. Next, I will take full 150 and I'll put it for marketable securities. Why? Because these are securities which has an open market. So what makes me feel that if I'm not able to sell it at the market value today. So now I'm left with $250,000. I will assume now that the debtors will pay me full because even these are highly current assets. Now I'm left with $125,000. Then I will allocate the entire amount to inventory. So now I'm left with only $25,000. The next item in my list is PPE. But the problem is in PP and E, I have two assets. I don't have one asset. Property, plant, equipment, land, all of these non-current assets, I have now more than one. What do I do? Now I'm going to split. Okay. So how much am I going to split? Sorry. How much am I going to split? I'm going to split 25,000. And on what basis? On the basis of relative fair market value of two assets. So the call of the question is how much will land be valued? I'll take 50 out of a total valuation of 125, which is the class that I'm talking about, right? And then I'm going to simply split $25,000 basis. So I think the answer becomes $10,000. So I have 50 out of 1 into 25,000. So the value of land in my books becomes $10,000. See, I'll read the provision again for you. If the lump sum purchase price is less, please remember this is a big if, only if, then you're going to allocate as per agreement between the parties in writing. If there's anything explicitly decided, go by that. But if nothing is mentioned, then you use something called the residual method, which mentions the order in which fair market value of property should be considered in case of lump sum purchase. First, take full cash, then full marketable securities, and full debtors and investments and inventory, then PPE, then intangibles, and then goodwill. And if in any one there are assets which are more, then you need to split it on the basis of the amount